Welcome to this explainer. Today we're going to tackle a universal pain point that absolutely plagues retail investors. But more importantly, we are going to decode the exact mechanics of institutional shakeouts using cold, hard, objective data. So, if you've ever felt like the market is actively, purposefully working against you, well, you're absolutely in the right place. Let's get into it.
Here is our roadmap for today's deep dive. We'll be covering 1. The institutional shakeout trap. 2. Extreme test, rapid reversal. 3. The golden pit pattern. 4. Multi-indicator buying resonance. And finally, 5. Ironclad trading discipline.
All right, starting things off with part 1, the institutional shakeout trap.
Now we've all been there, right? Have you ever held a phenomenally strong stock, watched it trend just beautifully, and then suddenly, out of nowhere, it begins this violent, terrifying pullback? You watch your hard-earned profits just shrink in a straight line. The psychological pressure builds up, and in a moment of sheer panic, you grit your teeth and sell. But the exact second you hit that sell button, the stock immediately turns around and launches into a massive upward wave. It literally feels like the market makers have a webcam pointed directly at your brokerage account, doesn't it?
That agonizing, frustrating phenomenon is exactly what we call an institutional shakeout. Think of it as a calculated squat before a high jump. Institutions actually manufacture this visual panic on purpose. You see, staring at those chaotic, wildly alternating red and green K-lines completely manipulates human emotion. It forces us into making unforced errors. The whole point is to shake out the indecisive, weak retail capital before the true, massive ascent begins. Without an objective filtering mechanism in our minds, we just fall victim to the illusion every single time. But today, we're going to fix that.
Moving right along to part 2, extreme test, the rapid reversal.
The best way to think about this pattern is like a single speck of green in a massive sea of red. When you see a terrifying price drop on the chart, it looks like an absolute slaughter. But the moment you introduce the MACD indicator into the mix, that terrifying drop is exposed for what it really is, a fragile bluff. You might see these massive, scary red candlesticks on the price chart, but down on the MACD, the green energy bars, which represent the short seller's actual power, barely manage to squeeze out 1 or 2 microscopic bars. It's the ultimate proof that the bearish momentum is actually incredibly weak.
So the absolutely crucial point here is the timeline. This extreme flash shakeout features an incredibly short-lived MACD death cross, lasting only 1 to 2 days. That's it. The fast line crosses below the slow line, but the duration is just a mere blip. This extreme brevity in time is your golden standard for judging a rapid reversal. The institutional washout action here is fast, it's accurate, and it's ruthless, but the underlying data proves it has zero staying power.
Let's actually put this into perspective by comparing 2 different beasts. On one hand, we have the rapid reversal. That's your 1 to 2 day lightning war that totally plays with your heartbeat and tests your acute sensitivity. But what if the market is moving a bit differently? Well, that brings us to our other pattern, the golden pit. This is more of a 3 to 7 day gentle tug-of-war, fundamentally testing your holding stamina and patience. This dichotomy is brilliant because it gives us a perfect mental framework. It shifts our paradigm from just reacting to a violent lightning war to actually recognizing the composed, steady tug-of-war, and that is exactly what we are going to focus on next.
Which brings us nicely to part 3, the golden pit pattern.
When you're looking at a chart and analyzing the golden pit pattern, there are 3 specific structural elements you need to lock onto. First, look up at the K-line. Notice how the candlesticks form this really gentle pullback while the moving averages start to coil tightly together. Second, drop your eyes right below the price to the trading volume bars. Notice how exceptionally shallow and sparse they are? That tells us there is no massive sell-off pressure happening. Finally, look all the way down at the MACD indicator. You'll see this brief death cross hovering just above the 0 line, and it lasts exactly 3 to 7 days. By combining that coiling K-line, the low volume, and the short MACD intersection, you visually and objectively prove that institutional suppression has completely lost its juice.
All right, part 4, multi-indicator buying resonance. To make this work, we have to treat our execution rules like an unyielding algorithm, no exceptions. Step 1. Patiently identify the MACD death cross. Step 2. Count the days like a metronome. Are we in that crucial 3 to 7 day window? And verify that those green energy bars are weak? Then step 3, and listen, this is the absolute focus here. You never, ever guess the bottom. You never try to catch a falling knife by buying on the left side during the drop. Instead, you decisively buy on the right side at the exact second the fast line hooks back up, and that golden cross is officially confirmed.
Now, if you really want to push this to a higher echelon, you start looking for multi-indicator resonance. This happens when multiple objective conditions magically align chronologically. Think about it. At the exact second your MACD forms that precise golden cross, maybe your RSI violently bounces back up, reclaiming the 50 midline. At the very same time, your 5, 20, and 30-day moving averages have completely coiled into a single tightrope, and the stock price suddenly breaks upward with a massive dominant bullish candlestick. When these totally independent indicators issue a buy signal at the exact same moment, it creates the ultimate pre-explosive signal that a massive monster stock is launching. When you see that setup, you absolutely cannot let it slip away.
And finally, Part 5, Ironclad Trading Discipline.
If we draw a line down the middle of a ledger, on the human side, we have total chaos. It's getting fooled by naked candlesticks, feeling pure visual panic, and blindly guessing bottoms. But on the system side, that's where we live. We have to apply what I like to call a priority override. This means cold, objective data strictly silences your fear. You must maintain laser focus on your K-line, your MACD, and your volume data, and enact a strict zero leakage policy for your emotions. Literally do not let an ounce of panic leak into your trading strategy. By relying on objective laws, like knowing that the def cross cycle is incredibly short and the bearish energy is totally exhausted, you use systematic discipline to completely conquer the weaknesses of human nature.
So, to wrap up this explainer, I want to leave you with a real soul-searching question. When you are out there in your actual live trading, what's your style? Do you prefer capturing the adrenaline-pumping, lightning-fast rapid reversal? Or do you lean toward the steady, grounded, and patient reliability of the golden pit? Remember, the framework we explored today is all about sharing systematic knowledge and decoding these patterns. It's not financial advice. The market is inherently risky, but as we've seen today, ironclad discipline and cold, objective data are what ultimately conquer the chaos. Thanks so much for joining me for this explainer, and keep mastering those charts.